Just some more insight into what is happening with the housing market. Scott Lawlor, CEO of Waypoint, joins us now. That's a multifamily property developer in the southern region of the United States, Florida, etc. Great to have you on the show, Scott. Let's talk a little bit about what is happening here. The mortgage rate has rocketed. We're now circa 6%. What impact is that having?
Well, it's important to remember we're in the rental housing business, and so that does make it tougher for folks to buy a house in the short run. And so whether folks have concerns about a recession or whether they're looking at a higher cost to borrow, that has implications for someone's ability and willingness to go buy a home, which has implications, therefore, for rental demand. So while it's tough from certain perspectives as it relates to rental housing around our region of the country, the implications are a little different. In some ways, it might work to our favor.
Scott, we have to talk about these mortgage rates. Sure, they're rising, but at what point do we start to see the demand destruction that I think a lot of people have been calling for? But ultimately, this is a sector, this is an industry where there is still a housing shortage. When do we see that breaking point?
Well, see, it's an interesting question because, obviously the home price appreciation we've observed the last few years is not sustainable. And I don't think anybody was rooting for, 20% annual gains to continue or thought they could. But I think a very, very important distinction we have to keep in mind is the run-up we've observed, the last couple of years, is very, very different than the run-up 15 or so years ago, which was heavily fueled by financing, right? We're living in an aberrational moment in time as it relates to folks with, remember ninja loans, no income, no jobs, whatever, and you go by 95% of your purchase price. That's not been what's driving things the last few years. What's been driving things the last few years is just fundamental supply and demand dynamics, which have been very, very favorable, as it relates to home values. So it's very important to keep that in mind. But, a little bit of a, people use the word reset. I don't know what the right word is, but that pausing a little is, I don't think bad at all. In fact, it might be a good thing for the economy more broadly. So where should it settle? That's hard to say. And I'm not sure we get to pick. But if we're looking at, and also it's important to keep in mind, right, the difference between declines and a decelerating growth rate, which is really where we are now, of course. I don't think anyone would mind terribly if we just settled in closer to long-term averages as it relates to home price appreciation.
In terms of what's happening on the cost side right now, building houses, Scott, we did see a drop today in housing starts, in building permits. What I'm also hearing is that we're seeing quite significant backlogs right now, so maybe it's understandable that actually builders are starting to slow down. What's happening in the construction market? What's happening in the ability of builders to construct houses, to get them to market? What are you seeing there? What do backlogs look like? What do costs look like?
So that's been, really the most difficult issue in our industry for, a good year or two now, which is contending with costs and contending with availability. And ask anyone who's any contractor or any developer, how they're managing that. And, under truth serum, they'll share with you that it's been chaotic and they're scrambling a bit. And that's because it's really been the only way to deal with it. We're all trying to buy stuff further out, further in advance and so on. But the fact is you really can't lock prices, right? With any amount of term. And so the increases in costs, similar to what I said a minute ago as it relates to housing values, the increase in cost is not sustainable. We're up near 40% in hard costs, what we call hard costs, which is really just, the cost to construct the property, materials and labor, 40% in about 2 years. I mean, that can't sustain. Fortunately, in our space, the rental housing market in particular, rents have gone up about the same. And so net, we actually have wound up better off, but that's aberrational and, as I said, not sustainable. We're going to need, right, to see the supply chain concerns settle a bit, right, to cause a little bit more of an orderly set of conditions, whether it's single-family home or multifamily. But as it relates to availability and cost, we do need the dust to settle. And at some point it will. I find it hard to believe that these supply chain considerations are structural and permanent,
Scott, you were talking about the cost. Let's talk about the hedging here, whether it's hedging against building costs or hedging against simply the rise in interest rates. How are you seeing that part of the market?
Well, it's tough, because I think, we'd all love to hedge, but of course, as the world gets a little crazier, the hedging gets more expensive. And so the market always prices so that, you're right at kind of right on the fence there. We historically have borrowed. We borrow on a floating rate basis as a developer. We typically get a construction loan, and we're on that loan for a few years. And for a long stretch, we did not hedge that interest rate risk because we felt comfortable with it. Of course, now we're looking at it very, very closely and are more inclined to. But as you know, similarly, the costs have gone up, and so I think we're in the same boat as everybody, which is. It's a tough one. I mean, it's gone up even in the last 24 hours. So you can add, several $1 million to the cost of, say, a $100 million project. But man, if you don't buy that coverage, you're also going to lose a lot of sleep. And so really, it's case by case. It's right on the fence. Our inclination generally is to take the risk off the table and accept a little bit lower return, possibly, but sleep better at night.
It's nice to sleep at night. One final quick question from me, Scott. How much are you paying your people relative to, say, 6 months ago? Do you get the people you need? Do you get the bricklayers? Do you get the electricians? Do you get what you need in terms of the people and the skills to do what you need to do?
The answer is yes, but it's harder. Same thing as it relates to costs. There's availability issues and cost issues. And so ask any contractor if they're scrambling more to keep a job staffed and therefore what the implications are for their bid and the implications for folks, sit where we sit as a developer. So yes, it's harder. It's harder to find folks. It's harder to keep folks, and it's more expensive to do so. But at the end of the day, I believe that's a cyclical matter, and in the long run, things will settle in the housing markets and the economy broadly, as inflation and so on, will settle more, in accordance with historic norms. But at the moment, it's tough.